Right, so hello everyone. My name is Shlomo Cooper, and I'm happy to be here with you. Today is we are 2 days before the end of January, 30th of January 2014, and we are here in TradeNet's trading room, and this is our weekly webinar. In our weekly lesson, we are trying to equip you with the best knowledge in Wall Street, available in Wall Street, in order for you to push you to be a better trader, to have better decision, and to have an edge. And you know that in every aspect in trading, not outside of the trading stock market, in the trading world, you must have an edge over your competitor, because if you don't have an edge over your competitor, you are going to be eaten by him. So, and of course, it's correct and it's right in the financial market to have an edge. And hopefully what we are trying to do here in our weekly webinar is to give you an edge over your competitors, over other players in the stock market. So today we are going to, I would like to cover two very important subjects. First subject is Ben Bernanke. Ben Bernanke is going to finish its term tomorrow. Tomorrow is the last day for Bernanke in its office. He's going to finish its 8 years term as the chairman of the Federal Reserve. It wasn't an easy, it wasn't an easy period for him, and he's going to give the wheel to Janet Yellen as of February, and we are going to talk a little bit about the quantitative easing. What is the quantitative easing? What is the tapering? We have to know what is the quantitative easing. We have also to know how the quantitative easing along the way during the last 5 years affected all the market gains. And we know we had tremendous gains, amazing gains in the market, actually the S&P 500. And if we are going to put it on the chart, let's have here a weekly chart. And I'm going to take the chart back to 2009 on a weekly chart. If you know something, we're going to use the monthly chart. This is the SPY, the ETF that tracks the S&P 500, and we have here a monthly chart from March 2009. This was the bottom of the financial crisis, and from there, from 2009 till today, till the start of 2014, the market actually went up about 170%. 170%. So this is sharp gains. One of the, this is the fifth biggest rally in the history of the market. Absolutely amazing. And one major driver of this amazing rally was the quantitative easing. So today we are going to talk about the quantitative easing and how and what is the relation between the quantitative easing, the QE, and the gains of the market, because of course the question now on the docket is if the Federal Reserve is going to taper, is going to scale back, to scale down, is going to exit the quantitative easing, the stimulus plan. Is the market going to go sharply down? I mean, if it went up during the stimulus, if we are going to pull the stimulus off the market, is it going to fall apart? So we are going to share with you amazing statistics about it, and how the Federal Reserve actually how it was able to push the market up, and is it going to actually push the market down now that it's going to exit the quantitative easing. The other question, the other issue we are going to deal today in our webinar is the 50 moving average. As you can all see on the daily chart, last Friday it was actually the worst Friday. Actually finished the worst week of 2014. It was actually the worst week since June 2012. So we have to go back more than 1 year to find such a bad week for the market. And as you can see, this is the 50 moving average. All right, so this is the rising 50 moving average, the green line, and the S&P 500, the S&P 500 actually closed below this line. So of course, the next question today will be, is the market going to go sharply lower, or is it a buying signal? And I would like to hear your opinion about it later in this webinar, and I'm going to show you facts, black on white, what the market is going to do when we are analyzing it on past performance, on past data, All right. So first of all, since the global financial crisis, the Federal Reserve has used the policy of quantitative easing. This is what we are calling the initials of QE, and the mission of the Federal Reserve was to try to revive the consumer spending and economic growth. Now, lower interest rates encourage people to spend, not to save. But when interest rates go so low, and we know that the interest rates in America went down to the bottom to around zero, and they can't go lower any further, the central bank, the only option that is left to the central bank is to pump money into the economy directly. And that is what we call quantitative easing, QE. The way the central bank does this is by buying assets, usually government bonds, and right now this is what the Federal Reserve was buying, government bonds, using money, and using money it has simply created out of thin air. No, the Federal Reserve is the only body in the world that is eligible to print money, to print dollars. So actually, it doesn't cost the Federal Reserve any cent. All the world that is using the dollar currency is actually paying here the price. Now, on December the 18th, that was last month, and we are going to see it. I want you to see it on the chart. So let's go back to a daily chart, all right, on the SPY, and that was the day. This is the 18th, all right. So you can that was the 18th, all right. This is the big engulfing bar on the daily chart. This was the day the Fed decided to taper its quantitative easing policy by $10 billion per month, from $85 billion a month to $75 billion a month. And actually, Chairman Ben Bernanke expects the program to wind down steadily through 2014 and conclude by year end, assuming, of course, the economy remains healthy. Yesterday, on the 29th, and we can see here the bar, what was yesterday, and the market, of course, went down yesterday. The Federal Reserve announced once again that it would taper quantitative easing by another $10 billion per month to $65 billion. So what is Fed tapering anyway? Tapering is a term that exploded into the financial lexicon on 22nd of May, when US Federal Reserve Chairman Ben Bernanke stated in testimony before the Congress that the Fed may taper. Taper is to reduce, is to scale down the size of bond buying program known as the quantitative easing, the QE. And the program, which is designed to stimulate the economy, has served the secondary purpose of supporting financial market performance in recent years. Actually, the Federal Reserve put a safety net below the market. So actually, it told investors, buy stocks, buy any stock in the world, buy any stocks you can, because we are going to put a safety net below the market. If the market is going to fall down, is going to go down, we are there to support it. We are there to support it, to put money into action. And this is why all the investors went into the market and actually were able to capitalize on amazing gains. Now, here is the fourth question. Here's the fourth question. Let's move the slide one slide further. The fourth question being made by too many investors, and too many investors are saying that Fed expanded taper, and this is the equation, equals stocks went down, and this is why we saw the market going down on yesterday action. But stocks yesterday actually were already down. They already tanked on Wednesday before the Federal Reserve announcement. And in fact, before today's rally, they were 4 down days for the last 5 sessions. All right. So as we can see, in the last 5 sessions, 1, 2, 3, 4, 5, we had only this one was the gain. All the 4 were down days. So obviously, the cause is elsewhere, which I will simplify as follows. The market is now down, or it was yesterday down, because everyone expected it to go up in January. We are going to end January tomorrow, and when everyone is on board, everybody was optimistic at the start of the year, and when everyone is sharing the same mind, then there are not enough new buyers for a while, which causes downside pressure. This is why the market is going down. As the pullback gains steam and more folks are panicking, more investors are selling all the stocks in their portfolio, this is what creates the next buying opportunity. That is exactly why it is often said that the market slides down a slope of hope and climbs a wall of worry. And probably you've already heard these expressions. And that is meaning, it means for us that it often does the opposite of what is commonly believed by investors. And this is the main issue of this webinar. What is the belief of most of the investors, and what is the wrong belief, and what is the right direction, what is the right action to take. So as a perception becomes more bearish, then this will be the time to buy. And by the way, if you are looking for an easy and logical place to make money, stock investing or stock trading is probably not for you. You have to think out of the box, and hopefully I'm going to show you a couple of ways to think today out of the box. And this is exactly what we are doing here in the room, and this is something that each of us can do right now to improve his trading and investment success. The big worry related to the Fed right now, and let's go back to the slideshow, is that now that the taper has begun, are US equities in store for a repeat of what happened in the last 2 times the Fed tried to exit from one of its quantitative easing program, and we are going to see it on a slide in a moment. The chart right now, or let's see it right now. The chart in front of you right now shows the S&P 500 since the start of 2008, with each period of QE overlaid on the top. So we have here the QE1, all right, and the colored area around the QE1. Then we have the QE2, the operation twist, and then the QE3. This is the action, this is the program that the Federal Reserve is right now having in the market. Now, looking at the chart, each shaded area corresponds to periods of big gains for the equity market. And depending on what date you use for the start of QE2, the S&P 500 has been up by more than 20% during each period. And here we have all of the periods, the start period of each program and the end period of each program, and what were the gains of the S&P 500. So for example, the QE1 starts on 25th of November 2008. That was the program that actually pulled the market from the bottoming, and it actually end here around the 31st of March 2010, and the market was able to gain more than 36%. QE2, it was hinted the QE2 here around the 27th of August 2010. It was actually started here around 2000 on the 3rd of November 2010. It lasted till the 30th of June 2011, and during this period, as you can see, the market went up 10% or 24% if you are taking the period of when the Federal Reserve actually hinted it on it in Jackson Hole. Um, since QE3 was first announced through the end of December 2013, when the taper first went into effect, the S&P 500 was up 26.6%. And since the taper went into effect, though on January the 1st, the S&P 500 actually is now down about 3% from the high. So the question is, will the 3% decline turn into a deeper decline like we saw during the last two periods of the Fed began to exit. And as you can see, here we have two periods between the QE1 and the QE2, and between the QE2 and the operation twist. And when the Federal Reserve wasn't in the market, in the first time the market went down here in the red circle by 9%. On the second term, it went down by 14.5%. This was between the time between the QE2 and the operation twist. So if the Federal Reserve is now going to exit, and now, or at least beginning to exit, are we going to see deeper decline? Now, the bulls will argue that at 675 billion dollars per month, the Fed is still in the market, or not 75 billion dollars per month, now 65 billion dollars per month. And for the bears, though, it is the direction that matters. And with the Fed just reduced purchases by another 10 billion dollars yesterday, the Fed is clearly on the way out. So this is very, very important. You can even, you can even take just click to capture the screen to have this amazing, amazing chart. Actually, the traders that are with me for the last 5 years actually saw this slide as the gains developed, and we made lots of investment decisions upon this diagram, upon this chart. And of course, and now that the Federal Reserve is out of the way, the risk of going down is going higher. Now, talking about efficiency, you know, last week we had a shortened week of trading. The market actually started on Tuesday till Friday. On Monday we didn't have the market because they had the holiday, Martin Luther King Day. And if talking about efficiency, the S&P 500 just needed 4 days last week, and it still managed to post its worst weekly return since June 2012, and it declined during that week by 2.6%. And the move last week was definitely painful. And the start of 2014, look what we had at the start of 2014. The last 3 weeks, the market went sideways. It tried to break break out above the high of 2013, but it wasn't able to do so, and now it's actually going down. Now we have to note that the S&P 500 is still just 3 or 4% away from its record closing high, and a correction in the market, right? And the correction in the market, and this is the slide on the correction, or the terminology regarding considering the terminology of what is a correction in the market is considered a decline of 10%. So if that's what the current sell-off is, you may want to buckle up, because the market has went down only 3%. That means that in order to start to be considered as a correction market, we will have to see it declining by at least 7% more. The fact that it has been so long since we last saw a 10% correction in the market is exactly the reason why it feels so painful for so many investors. And forget about 10% correction, the S&P 500 has not even seen a drop of 5% since last May. Now, the sharp sell-off on Friday, let's get back to the chart, um, actually took the market below its 50-day moving average. And on my screen, on my daily screen, also on my weekly screen, you are always going to see 3 very, very important moving averages: the 20-period moving average, the 50-period moving average, and the 200-period moving average. So the green line, the green line is the 50 moving average, and pay attention that the market on Friday closed below the 50 moving average. Actually, it traded above it since October. All right, since October, it just traded above it, and this was the last fall below it. So generally speaking, the market is thought to be in an uptrend when it's being traded above the 50 moving average, and in a downtrend when it's below its 50-day moving average. So a close below the 50-day moving average, of course, is getting market technicians on edge. And given that it has been more than 3 months since October 2013, since the S&P last closed below its 50 moving average, Friday's break below certainly took investors going into the weekend wondering if a correction is at hand. So before sharing with you what the market is going to do statistically after breaking the 50 moving average, I want to hear you. What do you think the market is going to do, let's say, in another 1 month from now? Is it going to go up, or is it going to go down, considering it broke the 50 moving average on Friday? So I'm going to put it on a poll. All right, so this is the poll, and you are more than welcome to share your thought with us. 1 is up. That means you think the market is going to go up and is going to trade higher in another 1 month from now. Or the other option is down. Press 2 if you think the market is going to head lower, and we are going to find it much, much lower in another 1 month. All right, so I can see your answers. All right, and right now it's very, very one-sided. It's very, very one-sided. 86% of you are thinking the market is going to go down after the breaking of the 50 moving average, only 12% of you think that the market is going to go up. All right. So this is, or I understand your opinion. All right. And this is actually what I expected you to think, what I expected to see here in this poll. But let's see what the history and what the statistics is telling us. Historically speaking, we found that more often than not, the break below, and I'm just going to close, going to close the poll. We are finding that the market usually, after it breaks below, it's not as being indicative of an imminent sell-off. And let's take a close look on the recent history of this phenomena of the last 30 years, which is, by the way, very, very close to what we found in our research going back to 1928. 1928 is when the S&P 500 was established. All right, so this is the close below the 50 moving average on Friday. All right, and this is a table with all the statistics. Now, the table in front of you right now illustrates the recent history of this phenomena. In the last 30 years, there have been 23 instances where the 50 moving average was crossed after at least 3 months of closes above it. All right, so we are not taking into consideration every time the market is closing below the 50 moving average. First of all, we want to see the market trading above the 50 moving average at least 3 months in a row. So for example, the last time the market went above the 50 moving average, it was here on the 10th of October. From then till now, it was traded about 4 months above the 50 moving average. This is an instance we are going to study. We are not going to study an instance when the market is closing below the 50 moving average, like here around September, it's going up above, and in 1 month, it's going once again below the 50 moving average, because this is a short period that doesn't tell me the market actually traded higher and it actually was able to find its feet above the 50 moving average. So it's very, very important. The statistics is going after periods of at least 3 months in a row above the 50 moving average. This is what we have here. This is all the 23 instances. Let's take a look on the average, and the average, this is all of the 23 instances. For example, on the 12th of July 1983, the market closed below its 50 moving average after trading above it for at least 3 months. The performance 1 week later was a decline of 0.42%. 1 month after that, the decline was even harder, 2.41% down. But 3 months later, the return was up. Actually, it erased all the monthly, the bad monthly return, and it was back to green, 4.3% up. On average, and this is actually what we are showing you right now, over the last 30 years, the market has been up 1% on average 1 week after the market closed below the 50 moving average. But actually it's going even better if we are taking a larger time frame. If we are measuring 1 month return, 1 month return is going higher by 2.95%. And actually the last instance we have here was on 18th of April 2013. So let's go back on the chart to see the last time the market went below the 20 moving average, the 50 moving average. All right. So that was here. All right, so you can see actually the bar actually is resting on the 50 moving average, but if you are going to take a closer look, you will see that the market actually closed below the 50 moving average, and that was a very good buying signal, not a selling signal, and the market went up after that, 2.82% 1 week later. 1 month later, it was up 8%, and 3 months return was was set on more than 9.5%. So on average, 1 month return is set on almost 3%, whereas the 3 months return set on 4%. So actually, this is opposite of what you thought, and actually what most of the investors are taught to think when we are considering a break of the 50 moving average. Now, how we are going to translate it into making money? That I'm not saying you should buy it the minute the market closing below the 50 moving average, and if you are going to do so, you are going to do very, very well. And actually, one one of the systems the hedge funds are looking to do is to find statistics like this, a very, very solid statistics that gives you a very precise tendency over the long term. And if they are now investing upon these statistics, they are going to be very, very happy and very, very rich, because this is the statistics. This is what the market did in the past. This is what the market actually is going to do later in the future. Now, so you don't have to buy the first day of decline, but you can try to figure out when we have a reversal. For example, yesterday we had a candle we are calling inverted hammer. Inverted hammer. So we like to buy any correction after after we have a stopping bar like inverted hammer. The trigger is above the tail. So once the market or once the instrument is being traded above the tail, this is when we are buying. And actually, I have to disclose that today I've already bought the SPY, and I'm going to hold it for another 1 to 3 months. Hopefully, it's going to go higher by about 5%, and we will be able to capitalize. So if you didn't still took the SPY, the S&P 500, actually you can use the juicy ETFs like the SSO or the U Pro in order to have a vehicle that can cope, that can copy the performance of the S&P 500. You can also join this trade above 179.50 point, all right, above the last resistance. So if the market will be able to clear last resistance, this is another option to jump on board, to jump on the on board, and to enjoy these statistics, to enjoy the tendency of the market to go higher after it's breaking, after the first break of the 50 moving average. All right. Any question about that? What do you think about that? All right. All right, guys. All right, so this is our webinar for this week. Hopefully it's useful information. Hopefully you can take this information and translate it into money. Again, the mission for us is to give you a better understanding of what the market is, how the market is working. We all have lots of beliefs that when we are coming to the stock market, that a lot of time they are being it's not a truth, it's a lie, and we are being taught to think like this, but the market actually is operating in the opposite direction. All right, so thank you very much, and I'll see you all in our next webinar next Thursday with more useful information. And until then, I wish you all happy trading and good results. Bye bye all. Yes, all right, till I can put my mail. This is shlomo@tradenet.com. No problem.